Hey there, welcome to another week of Mortgage Market Movers Weekly, where we keep you up to date with everything going on in the world of real estate. A couple weeks back, we did an interview style with local realtor Alan Parasso, and this week we are bringing back the interviews. Let us know if you like these down in the comments, and this week we will have someone from the commercial world talking about multifamily style living and how that impacts the residential world. Just so you know, the interest rates, the average 30-year fix is sitting around 6.65. Now we're going to hop into the interview. Enjoy. All right, this is going to be for the week of March 31st. You know, typically we do the data thing. We had a guest speaker on, I want to say a couple weeks back. A couple videos back because I was in Japan, but I think it'll be nice to do these little segments of different real estate folks so you guys can kind of get a wide picture and just different vantage points of what's going on in the real estate world. And even if something might not connect directly to residential, it might connect indirectly. So today we have Tyler Drucker on. He is from the commercial side of things, and I'm going to let him introduce himself.
Hi, everybody. My name is Tyler Drucker. I work with a company here based in Jacksonville, Florida called Rise Real Estate. We are a residential development company, in-house general contracting company, and also in-house property management company. The firm has been around for about 30 years, and we have a few different disciplines. I specifically work on the market rate side of things, and my job is going out and identifying future potential development sites and then bringing them through the rezoning and entitlement process.
Right on, man. Cool.
Yeah.
So, break it down for a dummy like me, right? I'm just a simple loan officer. I get the people into the houses. I get them their money. So, I guess just if someone was watching this, and probably a lot of people that watch this are going to be, if anyone is watching this, they're probably going to be, potential homeowners in the future, right? We might have some other real estate folks, but a lot of these people are going to be lay people. They might not be in the business. Why don't you just maybe like a day-to-day thing, and if it's not as redundant as like a day-to-day, everyday thing, maybe tell us like some of the like big picture things you may go out and do, and on a given project, day to day, whatever structure your job
For
involves.
sure. For sure. I think you kind of said it best. Every day, something that I truly do love about the job is that every day is quite different. But from a overall big picture perspective, on the front end, I am doing some preliminary market data, doing some research, understanding the housing trends going on, because one facet of my job that I really do like is looking into the future, as it could take a year to get a rezoning done and then potentially 2 years for construction. From the day I identify a piece of land that I think could be suited for an apartment complex, it could be 3 years before we even have anything to lease, to sell to the market. So we have to be projecting out 3 years into the future, which can be quite a challenge at times, given that nobody really knows what the future holds for us. So we're always on the front end of things, from a data perspective, from a trends perspective, trying to really meet the market as our property will deliver. Obviously, we're making decisions today that are going to be, impacting the future. So that's kind of the front end of things. And so once we feel comfortable with the market, obviously Jacksonville is a growth market. We have north of 30,000 people moving here every year. We've had multiple large companies identify Jacksonville as a new headquarters. Obviously, Florida is a business-friendly state. So there's just a lot of things trend-wise that makes Jacksonville attractive for apartment development. And I'm sure as you've seen, we've had a glut of new apartments, which I'll get into a little bit later. But primarily, we're looking for properties to go out and contract with. And then potentially, if it's already zoned, that kind of, makes the job a little bit easier and smoother. But um, typically what we find is these, infill opportunities in the suburban and urban areas are not zoned, and so we'll have to identify the property, contact the landowner. There might be a broker involved, so obviously we're building relationships with brokers in the market, and then we're gonna contract with the property owner, and then we're gonna essentially start the rezoning process. So that includes meeting with our architects, our civil engineers, kind of doing that preliminary site planning, and then obviously we're going to engage with a land use attorney, somebody local that has strong ties within the community, with strong ties with city council, and that will have a real good sense of if this property has potential to be rezoned. So, typically we would say would have about a 90-day due diligence process where we'll put up some earnest money, within that 90 days, we're really going to go through the feasibility. So we're going to put together a financial model known as a pro forma, and that obviously takes a lot of assumptions as to what's going on with the economics of the market. And so that's our feasibility study, if you will. And then, like I was just referring to earlier, we're going to put together a site plan. We're going to put together kind of a little package, if you will, regarding a timeline, essentially, because our jobs really revolve around timing of delivery for these assets. It's quite important to the investors. And so once we feel comfortable enough that we're going to be successful with the rezone and that we like the opportunity, we like the site, everything is kind of pointing in the right direction, we will, go hard on the property, as industry term and similar in the residential world.
Oh, guys,
Uh-oh.
we had technical difficulties. So let's
All right.
those.
Maybe, uh, am I good to go though?
Yeah,
Keep
yeah,
right
yeah,
back in?
yeah. We're rocking and rolling. So yeah. So
Okay.
everyone watching this, just my apologies. It looks like my Wi-Fi disconnected, but we're back. So we're making it work. Okay.
Perfect.
Anyway, yeah.
Yeah.
So yeah,
Awesome.
keep going, man. Yeah.
Awesome. Okay, so yeah, so once we get comfortable with the property, we're going to go hard, similar to the residential world, where that there's that non-refundable portion of the escrow money, and at that point, obviously, we've already had some preliminary conversations with what we call in the industry limited partners, which you can just think of as the investor in the deal. And so once we pass that due diligence part, we're going to be entering the contract phase. In that phase, what we're going to be doing is working on the full set of construction drawings. We're going to be working on all of the land use. Again, that process could take a year between the time that we, you know, go hard on the property, and by the time we actually have the proper zoning, it could be just an up zone or it could be a full PUD. And depending on the acreage of the site, it could be a minor modification or a major modification, and that'll really impact the timeline of the development. And so yeah, and in that process, we're also going to be soliciting for the debt and the equity. I guess a little bit of clarity as to how our deals are financed in a traditional structure, which not all deals are traditionally capitalized. But in a normal environment, you'll have a bank, which is going to be the lender, and then you're going to have an equity partner, the limited partner, and then there'll be a general partner or the sponsor, which is the company that I work for, as the developer. Essentially, have to have skin in the game. And that is your traditional structure. So in that time frame, we're rezoning, we are putting together the capital stack, and we're getting all the construction plans in order. And then essentially that will lead us to the financial closing. And at the financial closing, we'll have a guaranteed maximum price, also known as a GMP in the industry. And once we understand the plans, we know what that's going to cost. Our construction team has gone out to the market. They're talking with the subcontractors, and they've understood fully every screw, nut, bolt that's going to go into this property. They'll come up with a guaranteed maximum price. And then obviously, hopefully by that time, we'll have our capital stack finalized and we can have a financial closing, which essentially means we're putting shovels in the ground. And then from that part, construction will take it over. Traditionally, I'd say in an average 300 unit deal, it'll take about roughly 24 months from the day we start moving the dirt until we have a finalized property with a certificate of occupancy. And then once we get that certificate of occupancy, we start leasing. There's a little bit of pre-leasing that's going on behind the scenes, but that will really kick off the property management section of our business. And from then on, we're just trying to get people living in our units. So obviously that might sound complicated. It's even more complicated in real life. But that's kind of like the big picture of how everything gets to completion from the day we identify something till the day we have a product to lease.
Right on, man. Yeah, in real estate, I think that if you're not in the business, it's often overlooked how many different puzzle pieces have to get put together. It sounds like it's a ton for you guys, and on a smaller scale, but still a lot of moving parts, right, for residential.
Absolutely.
You mentioned almost having to have a crystal ball, right? You have to look into the future and say, okay, well, what's the likelihood of X happening? And on the residential side of things, I guess for new builds, right, that's a little different. But if you already have an existing home, right, 30-day contract, 45-day contract, really people are concerned with what's the rate looking like today, and then you get under contract, 30-day lock, and you're able to lock. There are things, of course, right, black swan events. Our most recent one was a sickness that shall not be named. No, it's COVID, right?
Of course.
So I guess with these things, you can prepare so much, but what does I guess do you guys have a certain bit of flexibility, adaptability, like baked into the model? I guess like what happens when these very unexpected events occur, which the current economic structure. The name of the game is volatility and uncertainty, of course, So how do you guys deal with those things?
Yeah, so as part of our fiduciary responsibility, we'll have to do stress tests on our pro formas and on our models. And so what we'll do is we'll run different scenarios to create some sensitivities within the market. Now, given what we just went through, nobody saw that coming, so nobody was stress testing their model for what just happened. But in a normal environment, we're looking at what happens if rent goes up by 5%. How does that impact the returns? What happens if rent goes down by 5%? What does that look like? And are we comfortable still moving forward? So there's different parameters that we'll put on these models and test it to see really that kind of bandwidth that the deal can hold and everybody feels comfortable with moving forward. And another thing I should bring up too is with regards to interest rates, we have two different financial events, if you will, in a typical merchant build, or merchant build meaning buy the property, build the asset, lease it up, and sell it versus a long-term hold. So in that scenario, we have two different financial events, and the first is the construction loan. And so that is a loan that is a temporary or more of a bridge type loan in nature. which is different from when we have an existing cash flowing asset. We'll be putting permanent financing on it.
Mm.
Similar to in the residential world, you're going straight to permanent day one.
Yeah.
But yeah, I guess that's the two different financial events,
Okay.
and how that kind of impacts our interest rates, and it's a little more risky, obviously, since we don't have a cash flowing asset. We're borrowing at a more as we say in the industry, a larger yield, larger spread essentially
Mm.
between what the banks are borrowing at, what they'll lend to us at, and so that construction loan is looked at a little more risky. And then once you have a stabilized cash flowing asset, you can move to a more, secure interest rate.
Okay, right on, man. I mean, I talk about this all the time, and anyone that is in residential side of things, and I'm sure just real estate in general, but interest rates, I mean, that's all anybody ever cares about, right? It's what's the
Mhm.
rate, what's the rate, what's the rate. So it's interesting to see it from a commercial side of things, where I guess you guys have two events that you have to look at, right? Two different time components to it too, right? So you would have the construction, and then once you get into the more permanent um, building, right? Um,
Exactly.
okay.
Exactly.
So what is the current state of, I guess, the commercial world as far as these huge complexes, right? So you guys deal with apartment complexes. What's the kind of how has the structure been? I guess do you see a lot of people renting right now? Are rents coming up, going down? And how's the overall economy impacting just the whole realm of apartment multifamily style living?
For sure. That's a broad question,
Yeah,
and
yeah,
one
for
that's going to
sure.
take a little bit of a story to answer.
Yeah, yeah, yeah.
But so essentially, where we stand today is a place of a certainty, but some hardship. Um, and I should explain what that really means. So times were good during, well, rather right after COVID. So we had a normal, stable economy, and deals were getting financed. Good deals were getting financed. Coming out of the great financial crisis, starting in about 2013, started that kind of, everything was looking good. Demographics were looking good. Population growth was looking good. And all of these trends that we track every single day, everything started to make sense again in about 2013. And through 2019, everything was pretty smooth. We were in essentially an interest rate declining environment. Cap rates as well were declining. And so everything was kind of, moving along with homeostasis. And then obviously COVID happened, and the world fell apart, and nobody knew what was going to happen. I remember in the industry we were talking about, do we now have to start adding offices as part of our floor plans because this whole work from home movement. Um, and and that lasted only so long until we saw what we just saw in the economy when everything just inflated, and hyperinflated at that. We saw one of the greatest runs in construction pricing that we've ever seen. It went up about 20% a year for 2 years in a row, 2020 and 2021. Well, and it was really like 21 and 2022, but those years kind of, crossed a little bit. And so we had over 40% inflation in just the commodities in construction, which obviously skews our numbers dramatically. And so, but at the same time, we saw this enormous net migration from these, cities to the Sun Belt states, and Florida being one of them. Obviously, Florida grew by about, instead of that 30,000 number a year that I was mentioning earlier, specifically in Jacksonville, we went to about 47, just shy of 50,000 people annually were moving to Jacksonville. And what happened was all of the developers started to develop based off of these new numbers. And so essentially everybody in the industry decided that now's the time to go. We had all-time low interest rates. Financing was quite inexpensive. There was a ton of money that was ready to go on the sidelines from the institutional world, and it was the perfect storm to build a lot of apartments. We had over 10% of the inventory under construction, which might not mean anything to some folks, but in a normal environment, we would have about 2% under construction as related to the overall inventory of apartments, and we were over 10%. So just an enormous glut of apartments. And so then what happened was interest rates started to climb, and they climbed at a rather rapid pace. And that really was the impetus that halted the new development. So in 2020, 2021, and about half of 2022 was this great run when everything was easy to finance, land was available because we're in Jacksonville, and you just had this perfect storm that came together to build a lot of apartments. And that's what we did. It would have been great to have maybe some entities pausing a little bit, because what we're dealing with now is a supply-demand imbalance. We are so severely oversupplied that, and I'm sure a lot of people are notice this, that rents have come down. You know, they peaked and now they've come down dramatically. We're just about 8 to 9% rent decrease over the all-time high rent. In addition to that, we have concessions in the market rate apartment world here in Jacksonville. I've seen properties with small as 1 month concession and as large as 3 month concession, which is pretty significant, especially when we're looking at those financial models. Averaging about a 2 month concession, you're about 16% of your income is you're giving away for free. And so that dramatically impacts the numbers and the return metrics. And so right now what we're dealing with is a good fundamental market where we still have population growth, albeit not that 47,000, annual net migration number to Jacksonville. We're closer back down to that 30,000 a year number. So we're reverting back to the averages, to the mean, if you will. But what we're dealing with is just an oversupply. So essentially saying that once we get through this concessionary environment, it will, we're looking at about middle part of 2026. Jacksonville's absorbing just over 500 units every single month, which is roughly 2 apartment complexes. If you just average it out, obviously not, it doesn't work like that in the real world, but we're averaging about 530 units a month of absorption. And so that means in about the middle of 2026, we will have a equilibrium in the supply and demand, which means for our industry, that means that rents will continue to increase from that point on. Not what everybody really wants to hear, that rents are going to go up again, but that's just an unfortunate reality of the business.
Yeah, for sure. And one thing that we talked about with the guest that I had on last time, Alan, he's a local realtor here, was what you're seeing in the residential realtor world is more of a pre-COVID style, I guess, of real estate. And everyone talked about the new normal, right? And I think that maybe it lasted in some areas, but in real estate, do you see things going to pre-COVID, but because we did have COVID, it gave you all that supply, and also gave you things like the inflation, right, that we're trying to get back to, but some of that has gone back to pre-COVID, and maybe we just aren't ready for it, right?
Yeah, I would say yes and no. Definitely some of the metrics that we're tracking are reverting right back to those pre-COVID numbers, and it's starting to kind of make sense for us. The one thing that we're tracking pretty closely that has not gone back to those pre-COVID numbers is construction costs. That's really where a lot of our pain points are for the future underwriting of deals. As I was referring to earlier, we had about a 40% spike in construction costs over those 2 years, and we've only seen about maybe 20 to 25% come back down. Meaning that the construction costs are still a little bit too high for us to be able to finance new deals, because these investors are looking for particular returns.
Okay. One of the things that I like to do whenever I'm going weekly, and sometimes I do it, sometimes I don't. But I think it's important to look at the macroeconomy, and
Mm.
we aren't in a bubble here. It's real estate isn't isolated. Of obviously the macroeconomy is uh, you know so incredibly important to what we do, and unfortunately, with the macroeconomy, we have to look at some social situations, and it not. I guess I want to say not to be political in the sense of like not picking a side of saying good, bad, anything about this, but the
Right.
reality of just situations that we find ourselves in, that do um, correspond with the economy is one of the things that we're seeing is deportation of a labor force, and potential tariffs on things like lumber, steel, aluminum, copper. So, are you seeing the impacts of either of those on the business? You're going to get. I'm assuming the inflation is going to impact the construction cost, but also, I mean, an inability to get supplies. I would imagine, and also a reduction in the labor force, which might also inflate the cost of the labor force, right?
Yeah, that's a great question, and one that we're tracking on the daily. I'll go from the labor perspective first. Um, what I'll say is we have not yet seen an increase in the labor cost, but that's not to say that that couldn't be coming in the future. One thing about the apartment market world versus the single family world is that there's a different level of subcontractor. Um, when we're working with these large regional banks, they require a lot of the subcontractors to be bonded, which is, you can think of it similar to an insurance policy,
Okay.
and so that just kind of puts a few layers of extra protection, and also it means that yeah, well, I guess really what I'm trying to say is that we haven't really seen any sort of significant impact in the labor side of the equation. Now, going over to the tariff side, I just saw a great meme the other day, and it was relating tariffs to the Karate Kid: wax on, wax off. In the morning you have them, in the afternoon you don't. So
Hmm.
obviously, because nothing has really actually been inked yet, we haven't seen
Yeah.
the the escalations. However, what we have seen is people and manufacturers anticipating those tariffs, and because they can, they're just artificially inflating their prices.
Hmm.
Now, obviously, there's a multitude of things that will come with that. Obviously, if one is doing it and the other is not, we're going to use the other competitor of because there's so many different products out there that you can use. So it creates a little more competition in the marketplace. But it is something that we track every single day. We look at his Twitter, just to see what's going on in the market. So yeah, I think that's how we're kind of looking at it.
Yeah, I think you raise a really great point. It's not necessarily even what gets enacted, it's the anticipatory effect of potential tariffs.
Hmm.
This is not, I don't know, not to get too deep into like financial markets, but of course, financial markets are going to come up when you're talking about real estate because how could they not? Uh,
Right.
but when you look at like earnings for companies, I want to say like a ridiculous percentage of companies in their earnings calls discussed the impacts of tariffs on their business, and I think I could be mistaken, but I want to say that some have even started definitely increasing prices, just anticipating tariffs coming in. I mean, you don't want to be late to the game, right? The
Right.
company needs to make their money, and I don't think that they can really wager on a, well, maybe this won't go through, right? So you might see some of that already being put in place. Um, so I think that's a really great point to make, where that just could kind of be a reality, even though it's uncertain whether the tariffs are even coming or not, right? Um,
Correct.
okay, so rent right now, would you say it's a renter's market right now?
100% it
Okay.
is a renter's market right now. Obviously, I was referring to the concessions
Yeah.
earlier, meaning that renters are able to, if you move between properties, you can get that, 1, 2, maybe even at some 3 months free rent. Now, we in the industry, if we're giving out concessions, typically will require that the resident sign a longer term lease, so that we're still essentially economically receiving that 12 months of market rate rent from a rent roll perspective, and that just has to do with the how the numbers look. And so, but yeah, ultimately rent has decreased, and I think there's a lot of hunger, if you will, out there for new residents at a lot of these brand new Class A assets. And so, yeah, I think renters can be picky and they can negotiate right now. It used to be it's, take it or leave it in 24 hours, and we're going to charge you 20% over what the last, resident was paying. And that was just because we had a revolving door of new people coming to the market, and that's just dried up. So yeah.
No, would you say that, obviously with that would mean that the demand is low. So you guys have seen a decrease in your renters. Is that accurate to say?
What we've seen is a decrease from the all-time high
Okay.
back to the sort of pre-COVID norm.
Okay. You know, I think that if you heard that purely from the standpoint of a potential homeowner, and of course, me being a loan officer in the residential side, I think that could almost signal like, oh, well, potentially people aren't purchasing homes as much because it's more of a renter's market, so you can go out and rent, and it would be fairly cheap. Um, but I think from another perspective, it could be that maybe people are moving towards more owning. I think one of the numbers that we saw fairly recently, let me see if I can pull it up, but the purchase index has been going up for residential homes. I don't, let me see if I can find that really quick, but it was fairly recently that if you looked at the refinance index, that was fairly high. Purchase index was coming down, and that's kind of flip flopped. So I don't know if you guys have seen people kind of coming out of rentals. Um, and
Definitely.
I obviously it's hard to track if they're going on to the residential side of things, but that's what I would kind of think.
So for sure, what we've seen, and a lot of our specific properties are renters by choice. These are residents that could either purchase a house or rent an apartment for the lifestyle that renting brings. And obviously, it depends on the individual, but what we've seen is a large trend of obviously people moving to Jacksonville, Florida, and with that comes a lot of new home construction. And so, if you're purchasing a brand new home, but you're already here, you've already accepted a job, you might be signing a year, term at an apartment complex in anticipation of your home being built. And we've experienced a significant portion of our new leases over the last, call it, 4 years, are renters by choice who are just, people waiting for their homes to be built. And also, I think you did bring up a interesting thought process in that if it's a renter's market, maybe home buyers have slowed. I would say on the contrary, and I'm not looking at the data, but I think from my personal opinion, now is the time to be buying a house because prices have come off of their all-time high. You can still get compared to historical average, a reasonable interest rate. Interest rates have always kind of been in that 5 to 6% environment. It's everybody is still caught up on that 2.9, 3.4% interest rate, and that's just um, not really in our, like we were referring to earlier, where we continue to look at interest rates in the future. We're not seeing interest rates really come back down to those numbers over the next 15 years. What we're seeing, what we're projecting when we're looking at these forward curves, interest rates are going to trickle up slightly. And maybe, and again, that's not to say that they can't come down even further, but the point I'm really making is that historically interest rates are where they have been. I mean, go back to the 1980s. People were still buying houses at 18% interest rates. Um, so I think, to me, when I look at the housing market, now feels like a good time to buy because another thing to think about is home prices, specifically in single family, tend to appreciate over time. So if you're going to be living here in Jacksonville over the next 8 to 10 years, I think that purchasing a home wouldn't be the worst idea.
Yeah, and this is something I talk about all the time, and I think timing the market is absolutely ridiculous. And
Agreed. Very much agreed.
people, it's like I don't know, maybe it's a COVID fog. Maybe they can only remember COVID, right? But it's
Yep.
two 2% interest rates. They aren't here. I'm not buying. But I mean, that is silly. And of course, home prices, houses are expensive. I mean, homes. If you look at the median sales price of homes, they go up and up and up and up and up. That's not to say that there aren't dips along the way, but they tend to appreciate over time. Um, and they have come down a good bit. There's definitely, as like you said, on the commercial side, on the residential side, there is also an abundance of supply right now where we have seen
Hmm.
houses, and I'm lending side of things, but even talking with realtors and just, looking for my own research, I definitely see a good bit of inventory that's been sitting on the market. Um, that wasn't the case like a few years ago. And so prices are coming down, but interest rates also, they were just, I think the average 30-year fixed in January was like around 7%. It's probably sitting right around like 6.65, 6.63, somewhere around there. But I mean, that's the average, right, for the nation. Interest
Hmm.
rates have definitely
Right.
come down to a point, along with home values and purchases, where I do think it's definitely feasible for people to get into new homes. And the data even shows that. I just pulled up the economic calendar, and if you look at like pending home sales month over month, it's up 2% for the month of February. Um, and the previous month, which would have been for January, it was down negative 4.6%. So people are buying right now. I guess it is kind of a weird situation we found ourselves in with just this so much supply, right? And I think the market is trying to find equilibrium, where I think the power
Yeah.
dynamics are a little bit more even, or trying to get there.
Right.
Yeah, so I
Actually, can I ask you a question?
yeah, yeah. I love to be interviewed.
Okay, so yeah, so we're talking about inventory. I guess my question would be in relation to the pre-COVID numbers, maybe on a total number or on a monthly number. Where do we sit in terms of homes for sale on the market? I know we had I believe it was like less than a 2 month supply at one point. Do you know where we stand in terms of the overall supply and how that relates to the pre-COVID numbers in the for sale world?
You know, I will say, just because I'm on the lending side of things, I don't look at those numbers quite as much, but I will say Alan, who I just had on last time, was saying that the average sitting period for a home, I want to say it was like about like either 50 or 60 days, right? So that's 2 months. And I think anecdotally, I mean, go on not you, of course, but someone interested, right? Go on Zillow. I mean, look at some of these houses that have been sitting. I will say pre-COVID, and when I think of pre-COVID, I think of like I guess I'm talking about maybe like more like 2019. I think like in 2019, maybe
Right.
some of 2018 too. You put in an offer on a house. And I don't know if there was a ton of wiggle room. I could be completely off about this. I don't know if there's a ton of wiggle room with negotiations. Certainly during COVID, there was not. You had to offer maybe like 10K over. Um, I think now we
Right.
are seeing from the lending side of things more seller concessions and more sellers willing to give credits to borrowers. Say they might even put in their Zillow listing, right? Like 5K towards borrowers' closing costs, and I think that we're starting to see
Yep.
that. I don't know if you can quite get away with lowballing, some of these houses. Maybe if you're lucky. But I think that what is probably more likely happening is home values are not so inflated. They're coming down to like a little bit more reasonable levels, and sellers are willing to give closing costs. And I think in relationship to pre-COVID, um, I would think that, let's see, yeah, I, I would say that it is getting a little bit more equal to where buyers and sellers have roughly equal negotiating power. And maybe like right prior to COVID, that wasn't the case. And I do think it's a supply side thing where there's just crazy amounts of supply, lots of sellers. I'm assuming a good bit of investors came in during COVID and bought. I mean, with interest rates at 2%, if you had cash sitting on the sidelines, of course, that was the time to buy.
I think we might have broke up a little bit there at the last second, but you did actually spark something for me. Obviously, during COVID, we had a lot of interest from institutional purchasers in the for sale world. One of the things that even ourselves, we became privy to this term "build for rent,"
Mm.
which means and we did it ourselves in a townhome structure. It wasn't a detached structure from a single family perspective, but more of a rent. It is a rental community, but it looks like a for sale community. It's all single family homes. However, every single thing in there is a rental product, and it's managed professionally, similar to how we manage an apartment complex. In addition to that, over COVID, we saw a lot of these Wall Street firms
Mm.
purchasing single family scattered homes. and they were offering prices that really just didn't make sense. And I think even for their portfolios, they still don't make sense. And so we might see some of those homes becoming more for sale over the next few months. And then obviously there's some legal and government issues that they might have to endure. Obviously, as we live in the United States, and one proponent is that we like home ownership. And what we've seen is a lot of these institutions coming in, purchasing homes, and then renting them out. And I think that might play out unfavorable for them in the long term.
That's a good point for sure, man. I do definitely, I anecdotally, right? I don't have the data in front of me. I definitely seen a ton of renovations in homes in places like Murray Hill and Riverside, and I would assume too in like Springfield. Um, some of these areas where you probably could have gotten a home. I think you can probably go, and like I said, this is also anecdotally, but you could go on Zillow and look at the value of a home in probably 2020, 2019, a home that was 100K. Look at it today. I mean, trying to sell it for 350, 400. It's pretty crazy, and I think that these
Yep.
investors did hop on. And at this point, you can either hold your investment and hope for the best, but as values start to come down a little bit, you might get cold feet, on your investment, and you might want to put that on the market. And even if you aren't putting it on the market, because it is a renter's market, those investors that got the houses built for rent, they aren't able to cover that, perhaps that mortgage, or just they aren't able to get that profit they were used to getting. Now that the dynamics have been shifting. Um, so it's definitely interesting from a residential side to see how not construction, how the commercial side of things coincides with the residential side of things. I guess it's easy to think of them as two separate and detached worlds, but really, this is it's a system, right? The real estate system, where fluctuations in one market are certainly going to have impacts in other markets. Um, I think in saying that, is there, I I like to get like a little, what's your like tidbit if you had one of maybe something you would want to give someone. It could either be someone that wants to get involved in commercial, maybe someone that's in commercial, or maybe even someone. Are you hearing me? Okay, I think I'm having technical difficulties with the mic. Is everything good?
Yeah, I think the question is a little tidbit for somebody looking to get into the commercial side.
Either that, or I mean, even renters right now. Like someone that is out looking. Um, Maybe they aren't ready to quite own a home. Maybe they want to get into apartment complex. Do you have anything like for anyone in that space? And if you don't, maybe just kind of like a tidbit about the financial markets and kind of that ability to look into the future. Any kind of like tidbits of knowledge, any nuggets
Yeah.
that you would want to share.
Um, I'd say for anybody looking to get into the commercial real estate space, it is a phenomenal industry to get in. I think now, in specific, is a great time to be entering because we are just coming out of a depressed environment. Like we've talked about, obviously financing, capitalizing these properties has been quite challenging over the last 24 months. And as we look into the future, and as the oversupply gets absorbed through the middle of 2026, new projects will start to get financed. There will be more growth in the market because at that point, what will happen is there'll be no new supply to backfill the sustained population growth and demand that we will experience. And so, in my estimation, there will be a point in time where we go from a depressed environment where nothing really pencils and is feasible to a, if you will, the faucet will turn back on and deals will pencil again because we're going to have rent growth. And maybe we'll see if construction pricing will ease up a little bit. Obviously, with the infrastructure bill and these large projects, we're not seeing as much, you know, we're not seeing as much cost come down in the commodity side of the market. Maybe we might see some labor reduction, but I think primarily what we're going to be seeing is rent growth. And I think that for anybody looking to get into this space, you know, I think now is a great time to do that. And then for the renters, the little secret sauce that I give is if your lease is coming up and it's time for renewal, you still have about 12 months to strike a good deal before that supply demand imbalance meets an equilibrium. And I'd say now's the time to lock in that rate and get a good deal. And you're able to negotiate with the property managers.
Well, unfortunately, I missed the. One else. I had a little dropout again. I don't know what's up with my internet today.
It could be me. I don't know.
It's probably no. I'm just kidding. If you don't mind, just in case I didn't repeat that, just in case I didn't record, could you just repeat that little last bit? So if you are a
Yep.
renter and your lease is about to end, that's where I dropped out.
Yep. So if you're a renter and your lease is about to end, you can still negotiate a good deal. That's what I'm trying to say is work with your property manager at the property level, and you still have a little bit left of window before these rents start going up again. So if it's time for you to renew your lease, definitely negotiate.
Lock in that rate. Lock in that rate.
Yes, exactly. Lock it in
Sign.
now today.
Sign your
Exactly,
soul
because
away. Yeah, no,
yeah,
sign the contract. Okay, right on,
right.
Tyler. Well, thanks so much for taking the time, man. Do you have any final closing remarks? I know that was already kind of one, but if you have anything else, man, feel free to put it out to the interwebs. You know,
Yeah, if anybody has any questions, I can you can get in touch with me. I'll give Nick my contact details and happy to answer any questions.
right on, man.
So thank you so much for your time. Much appreciated.
Cool. Well, thanks, homie. I appreciate it. And yeah, so this was, if you guys like this, definitely leave comments and let us know down below if you like these conversations or if you'd rather me ramble and look at charts. So, all right. Have a great week, everyone. Have a great week, Tyler. Thanks, man.
Thank you. Take care.